Hello guys, and welcome back to the channel. Thank you guys for always coming back. To my new subscribers, thank you for joining my amazing family. You are most definitely welcome. If you're here seeing my very pretty face for the very first time, my name is Anita and I make content on finance, self-development and self-growth tips, faith-based tips, content as well. So if this is the kind of content that you would love, kindly hit on that subscribe word. Click on it right now. Click on the subscribe word down below to get subscribed to join my amazing family. Today we'll be talking about financial mistakes that we as individuals make that keeps us struggling financially or keeps us broke. So if this is the kind of content you would love to see, kindly watch till the very end. Do not skip any part. And do well to give me a thumbs up if you love this video. Share your thoughts and your comments in the comment section down below. Share with your family and friends. Let's get right into today's video. The number one tip, okay, financial mistake that most people make is living without a budget. It's very important that we know how much we are spending on every expenses, on each daily living expenses. We know how much we are spending. Budgeting helps us to track our living expenses, the essentials and the non-essentials. Living without a budget, it's a no-no, especially as someone who is trying to create wealth. To start your wealth creation journey, you need to. It's one of the basic, the very fundamental principle or rule to go by is to start budgeting. And I've already made videos on this channel about budgeting, so do well to check them out. Budgeting helps us so that we do not do impulse buying. We do not spend on things that we never intended to spend money on. It helps us to also track and see where our monies are going. There's the 50-20, 50-30-20 rule, whereby 50 is spent on your basic living expenses like food, like transportation, accommodation, and all that. The living things you cannot do without, your needs. You spend 50% of your income or salary on them, and then 30% on your wants. The non-essentials, you can do without them, but as human beings and as balanced as we want to be, we need to, treat ourselves. Maybe dine out once in a while, have that trip, that vacation. It keeps us balanced. I mean, it helps us to be balanced. And then 20% for our savings, for our investment, for our emergency funds, for our paying off our debts, for retirement is very, very important. So you can go by this simple rule of 50-30-20 rule so that you can start budgeting. As well as you go along the way, you can adjust it to maybe 60% for your daily living expenses and 20 for your wants and 20 for your savings and investments. Well, depending on how well, whatever will help you, but you really need to do what helps you. You really need to budget, guys. Number two, guys, number two, or the second financial mistake we make is carrying or having high interest debts. We go for loans because we didn't save for a particular thing, maybe an emergency that came up. And these loans come with interest. The more you wait and do not eliminate or pay off, the higher the interest accrues or goes up. And so it's important that we find a way, we strategically or aggressively eliminate those debts as soon as possible so that we can eliminate the high interests on these things. Time is of essence, and the more you wait, the higher your interest goes up. Three, guys, not having an emergency fund. An emergency fund is very important. It's very crucial for our wealth creation journey. I already have content on emergency funds on this channel, so kindly do well to check them out. Emergency funds are savings set aside just for emergencies. They're inevitables. Things do happen once in a while, and we also have a separate savings and investment fund as well. what the emergency fund seeks to do is to cushion us, is to serve as a buffer so that we do not dip our hands into our savings and our investments when the inevitable or when the emergencies do come. And we can save for emergencies, go for a high yield savings account, not a current account is a no, it's a no at all. Go, it's either a savings account or a high yield savings account, but preferably a high yield savings account. We can give you a percentage of, let's say, 5% or less. It's way better than savings account that gives us less than 1% per annum. Number four, guys, is overspending on the non-essentials, our wants. I've already mentioned our wants. As human beings and as balanced as we have needs and wants. We need to take care of our want, our needs first of all, very, very crucial. And then our wants come second. Five, guys, not saving for retirement early. It's very important that we start saving for in retirement as soon as possible. If you are in your 20s, for instance, and you start, when you start earning, maybe even in your teens, as soon as you start earning, start putting aside money for your savings account. There are a lot of pension schemes in our country, and wherever you find yourself, the country you live or reside in, look out for these pension schemes, and then automate some or budget some of your monies at the end of the month when you're paid. You automate some monies to this retirement or pension account. If your employer also pays for maybe your social security, in Ghana we call it social security and national insurance trust, SNIT. If it's being paid for you, you take advantage of that as well. But you also take advantage of other pension schemes, other pension insurances that can help you to save for retirement. Why we need to start early is to take advantage of time. Time is our best asset. It's our number one asset. When you take advantage of time, you start saving for retirement early, let's say in your teens or in your 20s. By the time you are retiring by the traditional age of 60 or 65, your principal amount would have gained a lot of interest over time, and that interest compounds and keeps compounding and compounding. Let's say 40 years of money compounding. It's a lot of money compared to someone who started in their 30s or 40s. A lot of young people do not see the need to start saving or investing for their retirement, but it's very, very important because of compounding effects. Sixth financial mistake that we make is a continuation of number five. We are saying we are saving for retirement, but one mistake that most people do is to solely based on their retirement account, the monies in their retirement account, which, mind you, might not be sufficient enough to take care of you after you stop working. Find other ways, do other investments, find ways of do investments. We have buying stock shares, going to real estate, having rental properties. All these are ways that can stabilize you when you retire. It's very important that you look at other options, mutual funds, treasury bills. Do your due diligence of researching for the the best investment for you, the risk level or according to your risk appetite. You need to start investing. Investing is the way to create wealth, and so look out for other investments that you can make outside of your retirement investment or retirement savings, so that it can serve as a buffer for you when you do retire. Guys, is ignoring our insurance needs. We have a lot. Insurance is a way of safeguarding us so that when the inevitable happens, we know that we are covered. Having insurances for our cars, our medical expenses, for our homes, for our warehouses and factories, businesses, and all that. It's very crucial. Having insurances really covers us when the unexpected comes. So if you're not having an insurance, I mean health insurance or medical bills and all that, it's a financial mistake that will keep you struggling, because when these inevitable and when the unexpected happens, you have to look for money by all means possible to solve that problem. And so having an insurance for certain things, it really, really helps us. Right, guys. If we want to purchase something, we have to save strategically towards it, especially the very, very big purchases. Let's say you want to buy an appliance for your home, or you want to even buy a home, let's say, whatever it is, or a car, whatever you want to purchase that really would require a lot of money, you need to save towards it. Do not just by impulse go and buy something you never planned to buy, or even if you plan to buy, do not have enough money to buy it. You need to save towards it till you are ready to pay it in cash. Something that you cannot afford like 2 or 3 times, you definitely cannot afford it. So don't go near it. Don't go and say, I want to purchase this home, I want to purchase this car, and I'll pay in installments. Paying in installments, it really goes with interest rates as well. And the more you wait, the longer it takes you for you to pay that debt or that loan, or pay for that car, or pay for that home, the more interest you realize you'll be paying at the end of your payment. And so take advantage and pay, plan and save for things, and then pay for them in cash. That will save you lots and lots of money. Financial mistake that we make is not seeking financial education. Financial education is of utmost priority. Knowledge, they say, is power. I've spoken extensively about financial literacy, financial education on this channel. So do well to check them out. It's very important. You have to know about money, steady money, know the ins and outs, the do's and don'ts of money. It's very important. If you want to make money or create wealth, you need to learn about money. And guys, not diversify your income streams. It's important to have multiple streams of incomes, but it's very important to have it in different fields. That helps us, because every investment and the season that it does well all makes brings money. So it's important that we diversify, so that when this particular income is not coming, I mean the other one would stabilize you. Lastly, guys, overpaying for housing or accommodation. The general rule of thumb, okay, the general rule is not to pay more than 30% of your income, your monthly income, on your accommodation, spending money on your roof, the roof over your head. It shouldn't be more than 30% of your salary. And so if it's more than that, then you need, I mean, that is one of the financial mistakes a lot of people make, living in very luxurious houses that they cannot afford to live in, because their salaries cannot just support that. If you're spending more than 30% on rent, on accommodation, it's a no. You need to either downsize, or share you can share accommodation with someone who can also pay, let's say, half of the rent, or you can downsize, live in a smaller apartment or house or home. You can live in an environment that is cheaper but accessible, as well. And so there are a lot of options in terms of housing that we can save money on. Living where you cannot afford is a financial mistake. Cut your coat according to your size, basically. Guys, if you've loved this video, kindly give me a thumbs up, subscribe, click on that subscribe word down below to get subscribed, and let me know your thoughts in the comment section. What other financial mistakes are we making that you think are keeping us struggling, keeping us broke all the time in this life? Let me know your thoughts in the comment section. If I haven't already mentioned a particular financial mistake, we are all learning. So do let us know in the comment section. You want to check out my previous videos and watch out for the next one. Have a great day. See you in the next one. God bless us all. Bye.